There are three big problems with used vehicle appraisals. One, manually sifting through comp vehicles. Two, old book values and ghost comps. Three, no recon visibility. You can solve them all with AutoVision, launching in the Reynolds and Reynolds booth at NADA. Learn more at rayray.com/used-cars. That's REYREY.com/used-cars.
Want to dive deeper into the topics you hear about on Daily Drive? We're offering listeners a special offer, 20% off a 1-year Automotive News digital subscription. That gets you access to all of our news, information, and analysis made for automotive industry leaders like you. Go to autonews.com/Daily Drive promo to redeem. Welcome to Daily Drive for Tuesday, January 30th, 2024. I'm Jamie Butters, Executive Editor of Automotive News in Detroit.
And I'm Kellen Walker in Las Vegas. Today on the show, GM makes a big reversal on its all-EV strategy.
Our forward plans include bringing our plug-in hybrid technology to select vehicles in North America.
We'll also hear what Mary Barra had to say about GM's earnings in Q4. And Toyota leaps to record sales and production. Plus, we'll hear from Russell Hensley of the McKinsey Center for Future Mobility about how traditional automakers can do a better job with technology.
It's not that the traditional industry is hobbled. I think they have some huge strengths, which is they know how to scale. It's just basically getting over the innovation hump.
Let's run through all the news you need to know to keep up in the auto industry.
General Motors is making a big shift. It now plans to offer plug-in hybrid models in North America. CEO Mary Barra made the announcement during GM's fourth quarter earnings call with investors and reporters.
Let me be clear, GM remains committed to eliminating tailpipe emissions from our light-duty vehicles by 2035. But in the interim, deploying plug-in technology in strategic segments will deliver some of the environmental benefits of EVs as the nation continues to build its charging infrastructure.
It's a major change for the automaker, which has been moving toward full battery electric models while phasing out its pioneering plug-in hybrid technology. Late last year, the rapid growth in EV demand began to slow. According to the Wall Street Journal, dealers on GM's advisory committees have been urging executives to offer hybrid models. Barra did not say which segments will receive the plug-in technology or when.
On that call, Barra announced that GM's net income rose 5.2% to $2.1 billion in the fourth quarter. That means the company exceeded its full-year forecast despite the 6-week UAW strike and higher spending by the automaker's Cruise robotaxi business. Executives projected that earnings would be about the same or greater in 2024. But GM's fourth quarter adjusted pre-tax earnings and profit margin fell by more than half. Revenue declined 0.3% to about $43 billion. GM says higher vehicle pricing and an ongoing effort to reduce fixed costs by $2 billion, partly offset lower production and wider losses from Cruise. The automaker's North American adjusted pre-tax profit fell 45% to $2 billion, in part because of the UAW strike that lasted through much of September and October.
The world's biggest automaker just got even larger thanks to a year of record results. Toyota stormed ahead to all-time highs in sales and production in 2023. That's as the Japanese auto juggernaut put the microchip shortage behind it and ramped up factories to meet booming demand in the U.S. and Europe. That demand has especially grown for electrified vehicles. Toyota says global sales climbed 7.2% to more than 11.2 million vehicles. The results include sales from the company's consolidated Daihatsu minicar subsidiary and its truck-making affiliate, Hino Motors.
And Lucid has expanded its factory in Casa Grande, Arizona, by about 3 million square feet. The expansion is part of preparations for the launch of Lucid's Gravity crossover. The EV maker expects the Gravity to sell better than its Air sedan. The project brings the automaker's enlarged AMP1 plant to about 3.8 million square feet, more than 4 times its previous size. Lucid says changes to the factory will bring greater operational efficiency and cost savings. It did not say what the annual production capacity will be following the expansion. And those are today's headlines. Jamie, GM now plans to offer plug-in hybrids in North America. What does this mean for their initial EV plans?
There's always been this argument against hybrids that you're fundamentally paying for two powertrains, and so there's a inherent economic inefficiency there. GM really wanted to kind of skip that step. I mean, they had done hybrids and plug-in hybrids, but they really wanted to go all in on all EVs, just battery power, plug them in, charge up the batteries, and go. It's been hard for them to manufacture the batteries and the vehicles. It's been hard to find enough customers willing to pay the prices that are required. So, hybrids and plug-in hybrids are, again, looking like a good bridge to the pure battery electric vehicle future. And GM is adjusting course.
Gotcha. Coming up, McKinsey's Russell Hensley shares his thoughts on the benefits and challenges of new technology for legacy automakers. That's next on Daily Drive.
Daily Drive is kicking off the new year by reviving an old name in a new format.
We're bringing back a weekend drive edition of Daily Drive. Jamie and I will go deeper into the biggest automotive stories of the week.
Every weekend, you'll hear fresh insights, analysis, and what has me running hot, if not overheated. To think that's going to get done in a year, a little over a year, is foolishly optimistic.
That's a little dark, but let's shift to something a little more positive.
You'll also hear from our experts in the newsroom here at Automotive News about the latest industry trends and topics.
EV sales are not declining. That's the narrative we're kind of seeing outside of the industry. They aren't declining, but the pace of growth definitely has slowed.
Come back this weekend for our Weekend Drive edition of Daily Drive.
And of course, tune in every weekday for all the news you need to know to keep up in the auto industry.
Data is the backbone of your used vehicle department. You need it to find accurate comp sets and to best understand your market in order to make precise appraisal and pricing decisions. But it feels like you're always struggling to get the information you need. How much time do you spend sifting through comps because there are outliers that don't match the vehicle you're appraising? Do you frequently make manual adjustments to pricing recommendations? Reynolds' newest inventory management solution, AutoVision, can help. AJ McGowan, president and founder of AutoVision, explains how.
If you look at the way that cars are traditionally priced, you can get down to specifics in terms of, what zip code is it in and, what options does it have on it, some of those sorts of things. But the thing that's never really taken into account is, that dealer's, specific view of the market. Our goal with AutoVision was to use, technology that's available now to do real-time processing, which allows dealers to really set their view of the market into AutoVision. And then we use our tools to analyze the data that's there and show them this is what this vehicle is worth to you.
AutoVision can help you run your used vehicle department with precise comp sets, real-time inventory data, and reconditioning insights. Visit rey.com/used-cars to find out more. That's rey.com/used-cars.
Welcome back to Daily Drive. I'm Jamie Butters with Kellen Walker. How long have we been talking about digital disruption in the automotive industry? It's an ongoing phenomenon that offers both challenges and opportunities for suppliers, manufacturers, and retailers. For legacy automakers who see possible economic benefits of new tech, it's a race against new players who have had a tech-first approach from the jump. Russell Hensley co-leads McKinsey's Center for Future Mobility. He advises automakers on navigating software, autonomy, and electrification transitions. Hensley spoke with Automotive News Tech and Innovation team leader Pete Bigelow on Shift, a podcast about mobility. Here's a piece of their conversation.
We see automakers implementing electric. We see them implementing automated vehicle technology. It may not be fully automated, but advanced driver assist systems. So does a major advantage then sit with the traditional automakers in this larger mobility space, or are they too facing, a state of uncertainty or a state of flux?
I think it's challenges on both sides. I think, if you look at the traditional industry and the adoption of some of these technologies that are in the, I would say, relative infancy, maybe electrics are a little bit more mature than the autonomy and some of the self-driving tech because it's an incredibly hard problem to solve. But they can be challenged by innovation. They can be challenged by that risk taking. It's not necessarily been the card that they've played. The industry is very, very invested in brands that are incredibly expensive to build over decades and decades, and therefore they don't want to put them at risk. Where the other side of the coin, if you look at the startups and some of the innovators who are more likely to be risk takers, but they are challenged with going from a great idea, a great innovation, and actually scaling that to the size of the volumes that we like to see in order to again to make the profits that you need. So I think it's not that the traditional industry is hobbled. I think they have some huge strengths, which is they know how to scale. It's just basically getting over the innovation hump. And I think, again, if you look at the startups, it's more of a challenge of knowing how to scale and build things in the tens, hundreds of thousands, as opposed to the thousands.
I think there's a McKinsey statistic from a while back that 93% of the investment that's going into the auto industry is coming from outside the traditional automakers. That's kind of harrowing to think about. And what does that mean for the way that traditional OEMs can evolve, can develop new businesses that kind of propel them into the future?
Yeah, I think it's a good start. I think that it looks at external investments, and you've got these large global players on the tech side of things that have got really deep pockets and valuations that help them make investments and big bets. And I think if you take a little bit of a step back, Pete, that's one of maybe 4 or 5 aspects or attributes that you would think about when you think about transformation and the transformation that we're going through. So for sure, investment, which historically has been led by incumbents, in the form of R&D and the 3.5% to 5% of revenue that gets invested every year, is increasingly led by newcomers. And to your point, since 2010, I think we've seen 850 billion plus being invested, and those transactions, 90+%, 93%, as you said, is non-automotive players or non-traditional players. So means a whole bunch of newcomers, some new competition. The second thing is, if you look at geoeconomics, as we call it these days, we've been used to, I think, over this last era of 20, 25 years, moving towards global trade, where you've got to kind of get your head around, is that going to continue, or are we going to move to more of a decoupled model as world order begins to shift, and we see these tectonic shifts. The third piece is technology, and historically, last 120, 30 years, internal combustion has dominated with a few different fuels, but that's clearly going through an energy transition and moving towards electrics. EV sales, as we've spoken about before, you will see adoption, but it will be in a kind of an S curve mode, like any other innovation, and we're in the early stages of that. The fourth piece of it is the customer. The customer, certainly for automotive, has been very hardware focused historically. If you look over the history of the vehicle, and that software differentiation is something that's increasingly prevalent within the vehicles. And one of the things at CES that you saw loud and clear was the software-defined vehicle. We've got, I don't know what it is, 2 to 3 times as much software in a vehicle relative to only kind of 8 to 10 years ago. And then the last piece of it, is the industry and this transformation of the industry. We've gone from these truly established supply chains and a tier structure to something that's quite different. It's a relatively new ecosystem of players where you've got something like a third of the value of the vehicle, or the cost of the vehicle, is going to be driven by the battery cell and the battery pack and what you do with that. So again, that brings on a whole new cadre of players. So net, it's not just the investment; it's the economics, the technology, the customer, and the industry dynamics that's proving an incredibly uncertain but opportunity rich environment for the next 15 to 20 years.
Russell, is this unprecedented that any company has to try and handle all these things at one time? Or is this or is there historical is there a historical vantage point on where you see these eras that are, very disruptive overall?
Yeah, I think it's a great question, Pete. And you'd like to think, hey, geez, nobody's ever dealt with this before, lived through these kind of challenges. But actually, this, the side of some of the talks that we've had is based around this permacrisis. And if we look back in history, there's basically three major times when we've had such uncertainty, and they tend to occur right at the beginning of a new era. A new era being, the kind of 20 to 30 years where you have somewhat of a stable environment, or at least a consistent environment. So if you take 44 to 46, we had, the foundation of the World Bank. We had currencies that were pegged on the US dollar. The atomic age began. It was the end of World War II. You had the rebuilding of Europe. You had the Marshall Plan. That was 44 to 46. And that was followed by what we call the post-war boom, where you had these, upper 2.5% to 3% growth rates for that kind of 20 to 30 years. That was then ended where we had the 71 to 73, where we had, Japan surpassed the German GDP, which was shocking at the time. I know because I was alive, Pete. You had the oil crisis, you had Vietnam withdrawal, you had inflationary recession, and you had, say, chaos for a few years there, oil crisis to be one of them, followed by what we called an era of contention. And again, that 20 to 30 years, relatively low growth rates. It wasn't the 2.5% to 3%. It was more like the 1 to 1.5%. Very different growth rates. Then 89 to 92. The Berlin Wall came down. We had the Gulf War. The World Wide Web was invented or birthed. We had the Maastricht Treaty. You had disintegration of what was called the USSR. So the Beatles song no longer was as important as it was. But you had that, followed by what we call the era of markets, and we had this globalization thing that happened until we had this thing called COVID. In 2020. So this start of uncertainty, and probably the end of an era and the beginning of a new era, started with COVID. Then we had Russia invaded Ukraine. Then we had the chip crisis. Then we had inflation. Then we had changing role of China, a labor crisis that just happened in the last quarter, believe it or not, Middle East conflict. And then we've got this thing called AI, an AI singularity. To a point, we have these periods of what feels like chaos when you're living and managing and leading through them to any executive. That is in essence, it's the start of a new era. The question then becomes, Pete, what defines that new era? And literally there are 4 or 5 things that define the new era, and this is where we encourage executive teams that clients to actually think through in terms of world order. Are we going to have the decoupled world? Is it going to be global? What's going to happen in terms of tech? Acceleration, we talked about the software-defined vehicle. What does that mean for me? Demographics, we've got far fewer workers as the boomers retire and the echo boomers begin to retire. So the workforce isn't going to be as abundant as it has been. Then your fourth one is energy, and this energy transition to electrics. It's not going away. What's it going to do over the next 10 to 20 years? And then finally, capital. As we said, capital isn't as cheap as it has been historically, and what's going to happen with capital over the next 10 to 20 years. So those 5 things, if you have a perspective on those 5 things, then you've probably got a reasonable idea, although there is enough uncertainty around today, of what the next era may hold for us.
Russell Hensley co-leads McKinsey's Center for Future Mobility. He spoke with our own Pete Bigelow on Shift, a podcast about mobility. You can hear the full conversation on Shift wherever you get your podcasts. That's Daily Drive for today. I'm Jamie Butters.
And I'm Kellen Walker. Thanks to Automotive News coordinating producer Jake Neer, as well as our own Lindsay Van Hully, Hans Greimel, and Lawrence Iliff for their reporting for today's podcast. You can get the latest news on earnings, powertrain technology, and everything happening in the auto industry at autonews.com.
Come back tomorrow for my conversation with independent dealer Amanda Gordon about the state of the used car market.
Where I was about 20% cash purchases, now I'm seeing closer to 50% cash purchases. And that's the people who are saying, I'm not paying these crazy interest rates.
If you enjoy the podcast, remember to like, leave a review, and subscribe so you never miss an episode.